Good afternoon. Thank you for joining KBRA's webinar today, which will focus on the UK RMBS market, building societies, as well as our UK sovereign outlook. My name is Mauricio, and I head KBRA Europe. We are hosting a series of webinars across KBRA to provide market participants with our insights as we all continue to navigate through the credit landscape amidst the COVID-19 crisis. We hope everyone, along with their families, are staying healthy during these unprecedented times. As the crisis unfolds, our thoughts are with the individuals and families who have been most affected. For those of you who may not be aware, KBRA is a global rating agency with over 37,000 ratings, which equates to $2 trillion in debt. We have 5 offices worldwide with over 400 employees and ratings on over 350 issuers or transactions in Europe alone. KBRA ratings are fully eligible for Bank of England ABS and RMBS schemes, in line with our acceptance by the Federal Reserve in the US. Today's webinar is partly a result of the cancellation of the annual Building Societies Conference that was due to take place in early May. It is also the confluence of 3 research pieces on the impact of COVID-19 on building societies, the United Kingdom, and the UK RMBS market that we have published in the last 10 days. My colleagues will take you through our thoughts. They are Alan Madden, a director in our Sovereigns Ratings Group, Sirugudi, senior director in our RMBS team, and finally Asha Drobnik, a director within our Financial Institutions team. Our presentation slides, along with related research and ratings reports, are available for download under the Handouts tab within the GoToWebinar platform. We'll be saving the Q&A at the end of today's session, so please submit questions through the platform at any time during the presentation. If we do not get the chance to get to all the questions, we will certainly follow up with each of you directly. Lastly, a recording of the webinar will be circulated to all registrants in the next day or so. I would now like to turn over to my colleague, Alan Madden, who will provide an update on our thoughts on the United Kingdom sovereign credit in the face of COVID-19.
Thanks, Mauricio. Next slide, please. Thanks. As Mauricio said, I'm going to provide an update on the KBRA's view on the UK sovereign credit. So on April 3rd, we affirmed the UK sovereign credit rating, the long-term issuer rating at AA+ with a negative outlook. We have had a negative outlook since we first assigned the rating on the United Kingdom back in August 2018. The negative outlook generally reflects the uncertainties of, at the time, the UK's departure from the European Union, which obviously has since been resolved at the first stage, with the UK successfully departing on the 31st of January. The second part of that is obviously the future trading and commercial relationships between the UK and the EU, which have still yet to be resolved and have been further complicated by the outbreak of the COVID-19 coronavirus pandemic. The key credit considerations that form our opinion for the UK sovereign credit are the UK's large, advanced and resilient economy, despite obviously the headwinds that we're seeing from Brexit and more near term from COVID-19. We also look at consider the UK's flexible policy environment and its ability to respond to crisis in a timely manner. This is highly evident in what we've seen in the quite extensive policy response we've seen from both the UK government and the Bank of England in recent weeks in response to COVID-19. We also consider the high degree of finance and flexibility for the UK and its public finances. Obviously, the sterling's minor reserve currency status. We look at the safe haven status of UK gilts and strong demand for government gilts as important credit factors. We also view the fact that the UK sovereign is less reliant on external market developments as an important consideration, given that about 70% of UK debt is held domestically. Also, the very lengthy weighted average maturity of UK government debt in excess of 15 years, far in excess of any of its G7 peers, is also an important factor for us as it reduces refinancing and interest rate risks for the UK sovereign over the medium term. And we also believe that the increased debt burden for the UK will be supported by a favourable financing environment, as Bank of England quantitative easing should keep sovereign funding costs quite low. Other important considerations for us is, as part of the rating, was the future status of the UK's globally important financial sector, given London's status as a major global financial centre. And obviously a very important factor is the future trade and commercial relationships between the UK government and the EU post-Brexit. We have made our rating affirmation assumes that the UK will request an extension to the transition period. Obviously, the transition period is due to end on the 31st of December 2020, and any extension request has to come before the end of June this year. Now, we think because of the near-term policy focus of the UK government, and let's be honest, every government is on dealing with the fallout of the COVID-19 pandemic, that Brexit has kind of taken a small bit of a backseat. We obviously negotiations are still ongoing in the background. We have seen another round of negotiations start yesterday, Wednesday, between the Michel Barnier on the European side and David Frost and the UK government. Obviously, both sides remain far apart on crucial aspects of the future arrangement. So we feel, because of that factor and the difficulties in achieving a comprehensive trade agreement in such a short time frame, which has been further complicated by the outbreak of the COVID-19 pandemic, that we feel then that the UK government will eventually request an extension to the transition period in the coming months. And, slide 2, please. And just to give you a flavour of what we see as the potential impact on the UK economy. So the UK economic outlook was quite weak in the lead up to the breakout of the COVID-19 pandemic, as evidenced, in a slowdown in growth, obviously survey indicators and everything else. This is due to a lot of uncertainty over Brexit. Now, this is going to be exacerbated by COVID-19. The UK's national lockdown commenced on March 23rd. So a lot of the hits to the UK economy is going to arrive in the second quarter from April to June. What we are expecting to see is the sharp curtailment of economic activity is going to bring quite a deep recession for the United Kingdom. The hard data on growth figures and everything else is not yet available, and obviously there remains a huge degree of uncertainty of what will pan out. But the anecdotal and the survey evidence is highlighting quite a sharp deterioration in economic activity. So if you look at, say, the services purchase and manager indices, with obviously the UK being a heavily service-based economy, that fell dramatically from 53.0 in February to 36 in March. So well in contractionary territory, and more than likely with further declines to come. The likes of the consumer confidence, we've seen a sharp decline in consumer confidence in recent weeks. Even evidence such as new car registrations, which collapsed 44% in March. This is also borne out from what we're seeing in the labour market data. So what we've seen in the last 2 weeks alone of March was universal credit claims increased by 950,000. So with the further claims to increase in the early weeks of April and beyond, we're going to see quite a noticeable rise in unemployment rate. Probably somewhere at lower end of 8%. We feel maybe even higher towards 10%, depending on how the pandemic plays out. We feel in KBRA that the widespread effectiveness of the policy response and it will determine the scale of the downturn. We feel that it will help limit some, but not all, of the damage that COVID-19 will bring. And what's very important is the ability of businesses to stay afloat and people to remain and work, as we view as essential to the economic recovery. And this feeds into what we see as quite an extensive policy response from the UK government and from the Bank of England. So looking at the UK government response, it's been timely, extensive, and one of the largest globally to date. So direct fiscal support measures are in the region of 5% of GDP. So that includes increased funding for the National Health Service. We've seen the launch of the income protection schemes, where the UK government, via the coronavirus job retention scheme and also the self-employed income support scheme, will protect up to 80% of salaries of furloughed workers. We've seen an increase in universal credit payments. We've seen rental allowance support for affected persons. Also, we've seen the business support measures such as direct grants for small businesses in affected sectors such as retail, leisure, hospitality and tourism. VAT deferrals, business rate holidays, obviously are an important consideration as well for businesses, in that they've seen such a sharp curtailment in their economic activity that they have this window to sort of repay their obligations later on in the fiscal year. Obviously, then we have the quite significant coronavirus business interruption loan scheme, which will be administered by the British Business Bank. So it's 330 billion of guarantees for lending, up to 80% of lending by affected businesses. That represents about 15% of GDP, which is one of the largest guarantee schemes we've seen arrive in the face of the COVID-19 virus. The UK government's policy response has also been assisted by quite a significant policy response from the Bank of England. So we've seen 2 rate cuts to the bank rate down to a historical low of 0.1% in recent weeks. We've also seen an increase in the quantitative easing of UK government bonds and corporate bonds. An extra 200 billion was announced, bringing up the total quantitative easing package to 645 billion, which equates to about 30% of GDP. So yet again, another significant increase. We've seen new lending facilities announced, such as a term funding scheme for with incentives for SMEs, which has about a 200 billion package. And then we've also seen actions on the banking sector side. So the reduction in the counter-cyclical capital buffer to 0%, which is estimated by the Bank of England Governor Andrew Bailey to increase liquidity by up to 190 billion for the UK banks. The side effect or the impact of all these measures and the contraction of GDP will be quite a significant hit to the public finances in the near term. Direct government support, the sharp economic contraction, and the hit to government revenues brought about by the curtailment of economic activity will see quite a significant increase in the budget deficit. So prior to the crisis, the Office for Budget Responsibility were forecasting a deficit for this fiscal year, 2020-21, in the region of minus 2.4% of GDP. We are more than likely going to see the fiscal deficit hit double-digit territory in around the levels at the peak that we've seen in the global financial crisis. Obviously, we're also going to see quite a significant increase in the public sector net debt. Pre-crisis, it stood at about 80% of GDP. We are probably going to see it surpass about 100% of GDP, and also debt could rise further depending on how long the pandemic continues, and whether the government decides that further support measures are needed, and also with whether the government decides that vulnerable industries might need financial support. We feel that reversing the deterioration in the public finance will be a multi-year effort. We don't see a sharp snapback in the budget deficit and debt in a year or two time. It'll take a number of years to correct what is quite a significant shock to the UK's public finances. That will involve, which will need a strong nominal growth performance of the UK economy and obviously affordable sovereign funding costs. On the sovereign funding side, we feel that the UK's accommodative monetary policy stance and quantitative easing, with a skew towards government bond purchases, will help to keep sovereign funding costs low. This high degree of financial flexibility is very important for the UK to sustain its higher debt burden, which we feel is an important consideration given the sharp increase in debt. That generally outlines our views of the UK sovereign. There obviously is risk to any potential economic recovery. As it stands, there is uncertainty over how long the national lockdown will last. It could be a 6-week, a 3-month period. We don't know. There's no clarity over that. There's also issues over with potentially there's a second wave of virus infections which might necessitate new closures in the economy. That is also uncertain. I think, and also an important factor is the potential behavioural changes by consumers in the aftermath of the pandemic. Will people's consumption patterns change? Will they be as ready to to travel as much or visit restaurants and say cinema houses and theatres, given where there's a large confluence of people? That also remains unsure. And obviously on the banking and on the government side, balance sheet correction might be an important factor for these entities, given the expected deterioration that we might see. So the governments and the banks will have to focus on also correcting their own balance sheet, but also at the same time be in a position to support their recovery. So that kind of outlines KBRA's views on the UK sovereign, and I will now pass you over to my colleague Sirugudi, who will talk you through the housing market and the RMBS side of things.
Thank you, Alan. Good afternoon, all. I'm Kali Sirugudi. The UK government's efforts to flatten the curve with respect to the number of people falling sick due to the COVID-19 has meant that mortgage originations in the UK have decreased substantially. The reduction in originations is driven by the impracticality of conducting surveyor or structural valuations of properties, which have become nearly impossible due to the social distancing measures implemented. As we all know, such valuations are an essential part of originating and underwriting of new mortgage loans, and to a smaller extent for remortgages. Much of the current remortgage activity continues to rely on other valuation methods like AVMs or desktop valuations, as allowed under a lender's origination criteria. The response of building societies, banks, and specialist mortgage lenders to COVID-19 has varied from a complete withdrawal of mortgage products for new lending on one end to a tightening of loan-to-value criteria, or in some cases, an increase of interest rates. All of these changes reveal the concern UK mortgage lenders feel about the adverse impact of COVID-19 on employment, increase of delinquencies in the short term and defaults, and possible losses in the medium to long term. Due to the max LTV limits tighter, remortgaging for higher LTVs will become more difficult. At the same time, over the last month, the Bank of England reduced its base rate from 0.75 to 0.25% and subsequently reduced it further to 0.1% as a response to the economic impact of the COVID-19 outbreak. In turn, some building societies and other lenders began lowering mortgage interest rates as a result, while others have increased rates, though new remortgage volume may not replace the lost purchase volume. Building societies, banks, and other lenders have all offered to accept online or phone-based requests for a payment holiday of up to 3 months, in line with the UK government's effort to provide relief to borrowers affected by the COVID-19 illness. The UK government has also announced a moratorium on repossessions for the next 3 months. The immediate response for a payment holiday has been under 10% of the borrowers in the books being serviced by the lenders KBRA has been in contact with. This proportion is expected to grow in the coming weeks as borrowers or family members either become ill due to the spread of COVID-19 or experience income disruption resulting from social distancing measures. A request for a payment holiday by a borrower for the next 3 months is not expected to result in negative credit reporting towards a borrower's credit history, in line with the FCA's guidance for mortgage lenders and servicers. The payment holiday in most cases is expected to increase the monthly repayment amount once the payment holiday ends in an amount sufficient to enable payment of the unpaid interest accrued and capital over the remaining term of the loan. Borrowers can choose alternate mechanisms to pay the amounts due during the payment holiday as negotiated with the lender or servicer. Issuers and servicers that KBRA has been in contact with have also indicated that borrowers on payment holiday will not be considered in arrears under the transaction terms, which again is in line with FCA's guidance on this aspect. Some lenders or servicers may extend the maturity of the loan by a few months with no change to the monthly repayment amount. KBRA expects that not all borrowers in a mortgage portfolio will be affected by the immediate fallout of the COVID-19 illness in terms of income cuts or job losses, though the ultimate impact of COVID-19 remains uncertain at this time. Next slide, please. Servicing of UK mortgage portfolios in general is not expected to be materially disrupted for UK RMBS portfolios. As I've already mentioned earlier, servicers are receiving payment holiday requests online and through calls. Servicing teams are ready and planned for maintaining normal services from home due to the expected spike in borrower calls and staff absences from COVID-19 illness. Payment holidays will mean lower interest receipts in UK RMBS transactions, affecting the ability of the RMBS issuer to make interest payments on outstanding notes. Many UK RMBS transactions, including all the KBRA rated ones, have mitigating liquidity support features like a general reserve fund or a liquidity reserve fund, and or provide for the use of principal receipts to be used for timely interest payments on notes where applicable. So interest payments on notes, particularly on more senior classes, are expected to be unaffected. In KBRA rated transactions, Class A notes entitled to timely interest payments, failing which and even the default is triggered, are supported by multiple of these liquidity features. For the mezzanine and junior classes, interest payments can be deferred if there are insufficient funds to make these payments. So having understood the immediate fallout of the COVID-19, the development of any long-term stress in the UK RMBS transactions is dependent upon how quickly the UK economic activity, the housing market, and the capital markets revert to the status as of end January this year, already referred to by my colleague Alan. The UK government's strategy for exit from the current social distancing measures is eagerly awaited in this context. While a rise in unemployment is expected to adversely affect delinquencies and defaults in RMBS portfolios, it may also affect the demand of house purchases and, in turn, house prices in the UK. These together may have adverse impact on the junior notes in RMBS transactions through higher realized losses. And with that, I hand over to my colleague, Asha, to give you the perspective on UK building societies.
Thank you, Kali, and thank you everyone for joining us. To start with, I would like to clarify that our assessment of the building societies sector is based on the analysis of 17 largest institutions. Together, they account for almost 98% of the consolidated sector's assets. As Mauricio mentioned at the beginning, KBRA has recently published a report discussing the resilience of the sector amid the current market turmoil. As banks and building societies face tougher economic environment with rising unemployment and declining consumer and business confidence, problem loans will certainly increase from what is now very low base, and profits will be pressured across the banking system. Building societies' focus on residential mortgage lending leaves them particularly vulnerable to a downturn in the domestic housing market. Smaller societies might be more at risk due to their generally higher risk appetite for niche mortgage lending. That said, since the last downturn, the societies have improved their overall risk positioning. We try to illustrate it with the charts presented on the slide, showing higher capital and change composition of mortgage books across the sector. Over the last decade, the societies have become more conservative, with tighter underwriting standards, low and loan-to-value ratios, and a greater focus on customer affordability. In addition, they have significantly reduced their stock of more risky assets, such as non-prime residential mortgages or commercial real estate exposures. These are the lending areas which were subject to higher losses after the financial crisis. Next slide, please. As we move on to the next slide, we can see that the sector's creditworthiness is supported by solid financial metrics, with strongly performing mortgage book, stable funding, ample liquidity, generally solid capitalization and leverage, and lastly, weakening but still adequate profitability on a risk-adjusted basis. This provides a strong starting point going into this economically uncertain period. And this is particularly true for the large and better performing mid-size and small societies. Sector's profitability has been declining in recent years with pressure on net interest margin. This has been driven by an escalating price war in the mortgage market due to rising competition from non-ring-fence banks, as well as higher funding costs from refinancing of government funding schemes and MREL issuances. We expect profitability to come under further pressure from squeezed net interest margin and higher loan impairment charges. The latter are inevitably going to rise from their unsustainable low levels as the economic environment weakens. The society's future profitability also depends on their ability to grow the loan books. This is highly sensitive to the duration of the lockdown and slowdown in the UK economy. The economic downturn and COVID-19 related mortgage payment holidays are expected to weaken the sector assets quality, particularly if the economy does not rebound quickly. That said, the measures taken by the government to ease pressure on borrowers, combined with generally conservative loan-to-value ratios, should help to mitigate loan losses. In our view, loan portfolios of some mid-size and small building societies with weaker underwriting standards and higher credit risk profiles are more sensitive to the combination of an economic slowdown and high household indebtedness. Just let me conclude. UK building societies are vulnerable to a downturn in the housing market. The economic slowdown and mortgage payment holidays are expected to increase problem loans in the sector. But loan losses should be manageable, supported by the size of Bank of England intervention. The sector has become more conservative in the last decade, and its creditworthiness is supported by solid financial metrics. Thank you for listening. And on this note, I would like to turn it over back to Mauricio for conclusion and Q&A.
Thank you very much, Asha. Thank you to all three of you. That was excellent. So we do have a few questions that have come through. The first one is for Alan on the sovereign side, on your favorite topic on Brexit. The question is, KBRA's rating affirmation assumes an extension request to the transition period by the UK government. What happens if this does not materialise? What type of recovery does KBRA expect for the UK economy post-crisis?
Thanks, Mauricio. Okay, I'll take the rating affirmation and the Brexit extension question first. We feel that given all the uncertainties that COVID-19 has introduced, and obviously the chance for the UK government, even pre-crisis, pre-COVID-19 crisis, to agree a comprehensive trade and commercial relationship with the EU, the timeline was very tight. It was 11 months before the crisis intensified. It's even less now. We haven't really had any engagement between the European and the UK side for a few weeks now, given obviously more pressing matters. So we feel that any ability to enact a quite comprehensive trade deal is not really there at the moment. Hence, that we feel that a extension to the transition period is necessary. Now, we're not saying it has to be a 2-year extension. It has to be some extension that where the focus can move on from the COVID-19 policy response to back onto Brexit. Now, that obviously has to come before June. The UK government has obviously numerous times stated that they will not extend the extension request, and obviously it's also been written into UK law. But we feel, given the upheaval that COVID-19 has brought, that they will change. We feel that they will change their mind. That's the assumption we are making. That will obviously require parliamentary approval, which, given the Conservative Party's large majority, we assume that would be forthcoming. If it's not forthcoming and the UK government sticks to its current stance of not extending the transition period, it would be a major talking point for us internally. It would be something that will be considered, and it would be probably, and we would reflect that we have to reflect that in the UK sovereign rating. I'm not saying that makes a move on the rating, but obviously it's an important consideration for us that we would consider. On the second part, to the recovery, I think that a lot of that depends on really how long the pandemic, the national lockdown in response to the pandemic lasts, and the effectiveness of the policy response. Obviously, we've seen a quite significant move from the UK government and the Bank of England on the fiscal and monetary support side. Whether the lockdown can be, can be kind of quarantined, for want of a better phrase, to a 1 quarter period, that could see a pretty healthy bounce back in the latter half of this year, but we don't have much certainty over that at this stage. But I think what we do see is it's not going to be a case that the UK economy just bounces back to where it previously was pre-crisis times. There is going to be some collateral damage at the end of this. We are going to see, unfortunately, businesses no longer operating. We are going to see people, a higher unemployment rate and everything else. So what we are probably going to see is, when the bounce back does arrive, it'll be quite a decent bounce back, but there will be, unfortunately, there will be higher unemployment on the tail end of that. There will also be businesses that are no longer operating on the tail of that. So I'm not envisaging a V-shaped recovery as yet, probably more along the lines of a U-shaped recovery as we stand. So because what we have to expect is that once the restriction measures and the the containment measures are lifted, the economy will bounce back, but it'll be in stages. So, certain industry can probably go back nearly to full health quite quickly. Others will take time. By others, I couldn't mean the likes of the hospitality, the restaurant industries, transport, airliners, stuff like that might take a bit longer. So that's why we see more of a U-shaped recovery, kind of rather than a rapid V-shaped recovery. Thank you.
Thanks, Alan. Appreciate that. A nice segue for the next question that we have, actually, in terms of the shape of the recovery. And Asha, this is a question for you on the building society sector. How long do you anticipate building society's credit to evolve in the event of a prolonged downturn?
Thanks, Mauricio. That's a very good question. You see, the banking system as a whole and the building society sector will inevitably be weakened by the crisis. We will see higher non-performing loans, lower profits or losses, and less capital. And the key dynamic here is the duration of the crisis. See, if the customer's income falls only temporarily, more of them would continue to service their mortgages and our debt to the best of abilities. That's our belief. So, but some of the mortgage payment breaks given to the customers are gonna become a non-performing loans at the later stage. The scale of the NPL increase will depend on the duration of the lockdown, of the downturn, and how this translates into the increase in unemployment and the performance of the housing market. These two are the critical points in the asset quality and loan loss contents for the building society. But at the same time, let's remember that the building societies have stable funding bases, have ample on-balance sheet liquidity, as well as access to the liquidity facilities at Bank of England. So at the end, we believe that the failure rate of the sector will remain low, but we might see maybe some consolidation, especially among the smaller societies. Another thing to keep in mind is that majority of the existing societies, so those which survived the financial crisis, remain profitable during the crisis, although their profitability was significantly reduced. So if even in a few months' time, we don't expect any meaningful economic recovery, and we see NPLs escalating across the system, then we will definitely have another deep dive look at the sector and have another view at their creditworthiness. Thank you.
Thanks, Asha. That was a very comprehensive answer to the question. Callie, don't worry, we haven't forgotten about you. We have a question submitted for you as well on the RMBS market, and it relates to payment holidays. The question is, will loans get into default status if a borrower is unable to resume normal monthly payments at the end of the payment holiday period?
Thank you, Mauricio. I think the short answer to that is no. I will certainly pick up a part of the answer which Asha gave to the previous question and say that KBRA expects a proportion of the COVID-19 affected borrowers currently on payment holiday or in the process of getting one will be unable to resume normal monthly mortgage payments at the end of the payment holiday period. The key drivers would be loss of employment or an income cut, much in line with what you may have observed during the global financial crisis. I'm just giving the example of the last recession, a period of stress. Servicers will typically get in touch with the borrower through a letter after the loan is in the first month of delinquency. And if the delinquency status worsens, the letters are followed up with attempts to call and speak to the borrower. Now, that conversation enables clarity on the financial circumstances of the borrower and the path forward, either towards forbearance to help the borrower recuperate to a status where the loan gets back into a performing status, or the last option usually taken up by servicers, particularly for owner-occupied borrowers, being repossession and recovery. For buy-to-let, the path towards recovery may be shorter, but driven by the rental cover available to pay the monthly installments. So, and as we all know, for the time being, all foreclosure proceedings are banned by the government, whether existing or new cases. So once the courts do reopen, we can expect that the foreclosure process will see stretched timelines. So that's the short answer to the question. Thank you.
Thank you very much, Kali. Another very comprehensive answer. I think I'm going to leave it there, but I'm very sorry if I've been able to get to all of your questions. We will respond to all the questions, either by email or by phone in the coming days. So please rest assured on that front. Thank you for all your comments, and thank you for everyone that participated. KBRA strives to provide the market with timely and transparent research and analysis. Please contact any of my colleagues on today's call or me should you have any questions or need anything from KBRA. We very much look forward to working with you in the future, and thank you once again for your participation. Stay safe.